Chapter 5, Part 2. 1231 Property. Any gain recognized upon the sale of 1231 property may be subject to depreciation recapture. Recapture will convert that part of the gain from capital in nature to ordinary income. So the example here for depreciation recapture would be if you had a car and you go to sell it and you've taken 3 years of depreciation on the car and it's 5-year depreciable property and you still have a couple of years of depreciation, the depreciation expense that you've taken over the past few years is now going to be recorded as income. It has to be included with that because you took the expense, so now you need to offset it for the income. So that's what a recapture is. Other provisions governing capital gain or loss. You have a 1244 stock that can be subdivided real property, dealers, non-business bad debt. Maximum rates on certain long-term capital assets. Category, long-term cap gains, max rates could be 0%, 15%, 20%, and it depends on the AGI. Unrecaptured 1250 gain is 25%. Collectibles is 28%. 1202 stock is 28%. Maximum rates on certain long-term cap gains. Here's the chart for that. As you can see, long-term cap gains could be 0, 15%, or 20%. If you're single, you're going up to 39,375. If joint, you're going to double that, 78,750. Head of household is in the middle, 52,750. On the 15%, that's going to be if you're greater than 39,375, but less than or equal to 434,550. On the single, on a filing joint, you're going to be greater than 78,750, but greater or equal to 488,850. Or if I had a household, you're greater than 52,750, but less than or equal to 461,700. On the 20%, anything over 434,550, over 488,850 on filing joint, and head of household is over 461,700. Corresponding amounts of married filing joint are half of the amounts of filing jointly. Right? If you file married filing separate. The preferential rate is 0 for taxable income up to 39,375 if married filing separately. Breakpoint amounts in Table 5.1 will be adjusted annually for inflation. Netting realized cap gains or loss. Net gain or loss by short-term or long-term. Part A, combine short-term capital loss with a short-term capital gain. Net will be short-term capital gain or net short-term capital loss. Part B, combine the long-term capital loss with long-term capital gain. Net will be net long-term capital gain or net long-term capital loss. Step 2, you're going to combine the results from step 1 in the following manner. Combine any net short-term cap gains with any net long-term cap losses. And B, you're going to combine any net short-term cap losses with any net long-term cap gains. In step 3, you're going to combine the results from step 2, parts A and B. Result will be net capital gain or net capital loss. In part A, if step 2, part B is a net long-term capital gain, then determine whether the gain is from collectibles, 1202 stock, or unrecaptured 1250 gain. Segregate the gain into these categories. Step 3, Part B, any losses from Step 2, Part A that reduce net long-term capital gain will offset the category with highest marginal rate first. Collectibles and Section 1202 stock, and then we'll go to the next highest category, Section 1245 gain, etc. In Step 4, Part A, if the result of Step 3 is a net capital gain, then determine whether there is still more than one category of gain remaining. If so, the respective maximum rates will need to be applied for each category. Step 4, Part B, if the result of Step 4 is a net capital loss, then determine whether they can be divided into long-term and short-term losses, and then go to Step 5. In Step 5, you're going to apply the loss limitation rules. So in Part A, if part of Step 4, Part B, is categorized as a short-term cap loss, then it is used first to offset up to $3,000 of the taxpayer's ordinary income. Any excess short-term cap loss can be carried forward. If there is less than $3,000 short-term cap loss, then the long-term cap loss in Step 5, Part B, can be utilized to make up the full $3,000. Step 5, Part B, if a portion of Step 4, Part B is categorized as a long-term cap loss and there are no further netting opportunities available, then any excess long-term capital loss will be carried over to the following year's return. So on this flow chart, netting realized cap loss, right? So we start off on the left. You're going to combine your short-term cap loss with a short-term cap gain. Does this result in a net short-term cap gain? If yes, you're going to move down and say combine net short-term cap gain with a net long-term cap loss to come up with an adjusted or net capital gain, or adjusted net capital loss. Does the combination result in a adjusted net capital gain? No. Then the loss is deductible up to $3,000. Rest is carried over to future years. If it's yes, then the gain is taxed at preferential rates, depending on whether the assets were collectibles 1202 small stock, recaptured 1250 gains, or other long-term cap gains. Going back over here on the cap losses with the gains, does it realize into a short-term cap gain? If it's no, then it's the short-term cap losses are deductible as ordinary losses and can offset ordinary income up to $3,000. Cap gains may be taxed on the reduced rates for the long-term cap gains. Okay. And then if you can combine the cap losses with the long-term cap gains, does it result in a long-term cap loss? If it's no, then you're going to come back up here to the cap gain will be taxed. If it's yes, then you're going to come over here, and that's where the $3,000 is going to come into play. 1202 qualified small business stock, QSBS. Individuals can then exclude a percentage of the gain from sale of QSBS. Stock must be held for 5 years prior to sale. Stock must have been acquired after August 10th, 1993. The exclusion may not exceed the greater of either 10 million or 10 times the aggregate basis of the qualified stock. 1202 cap small business stock. When acquired, if it's prior to February 18th of 2009, there's a 50% exclusion. Between February 18th and 2009 to 9/27/2010, it's a 75% exclusion. After 9/27/2010, it's 100%. Sale or exchange, franchises, trademarks and trade names, worthless securities, patents, debt requirement, options, lease cancellations. Worthless securities, sale or exchange has occurred in that year that a security that is a capital asset becomes worthless. Securities include stocks and bonds. Taxpayer may realize and perhaps recognize a loss for the amount of security basis, since the amount realized will be zero. Retirement of debt instruments. Taxpayer will have a completed sale or exchange upon a debt instrument's retirement. The amount received will equal the maturity amount. Adjusted basis is generally what the taxpayer paid for it. If the bond discount is greater than 0.25% times the maturity value of X times the number of years to maturity, then the discount is considered original issue discount, which is an OID. You will find that on your brokerage statements. The original issue discount, taxpayers will need to recognize OID over the years to maturity. The OID will be taxable as interest income and then will add to the basis of the bond. The amount of the OID will be recognized will be determined by the constant instrument rate method. Market discount bonds are treated similarly, but use the straight line method in allocating the discount. The OID constant interest rate method increase the adjusted issue price that equals the adjusted price at the beginning of the accrual period times the maturity yield of maturity less the interest payments during the accrual period. The options, you have methods of disposition. You could sell, exercise, or expire. Patents, you have long-term cap treatment upon sales of patents, even if held for less than 1 year. The 1235 requires that the holder transfers all substantial rights in order to use long-term cap gain treatment. Rights transferred are not substantial if limited geographically or for less than patents remaining life. Starting in 2018, patents will be treated as self-created intangible assets, so creators may not be able to utilize cap gain treatment. The holding periods, generally short-term if property held is less than or equal to a year. Long-term is greater than a year. Exception, gifts and bequests, non-taxable exchanges, 1031s, or non-taxable stock dividends and rights. Tax planning considerations, transfer the property as a gift, transfer the property as a bequest. Compliance issues, documentation the basis, reporting of cap gains or losses, they're reported on your Schedule D, which you'll see. Thank you, and that concludes Chapter 5.